Housing finance companies have been the darlings of investors, at least in the early part of the year, with many arguing that this is a low risk, high growth business. And it is, but it's not possible to ignore some of the risks that have been emerging in this business. In a note issued on Wednesday, rating agency ICRA pointed out that the share of housing loans in the overall portfolio of housing finance companies has been declining. Instead, the pace at which non-housing loans are growing is picking up. The rating agency also pointed out that increased competition in the housing finance segment has led to some dilution of lending norms. Another important point highlighted in the report is that the geographical spread of loans has not widened as much as you would like it to. Kartik Srinivasan is head of the financial services business at ICRA. He's joining us for a sense of what's happening. Kartik, good afternoon. Thanks so much for taking the time to speak to us. Interesting report, because I think throughout the assumption has been that housing finance is the best business to be out there right now, and it perhaps is if you compare it to other segments. But I think you're highlighting one important point, that the proportion of housing loans in the overall portfolio of HFCs is coming down, particularly in some segments like smaller HFCs.
Yeah, what we've said in this report is we've done some portfolio cut analysis for about 24 companies from whom we have more granular data. The analysis reveals that the proportion of non-housing loans has been steadily but slowly increasing. One of the reasons for that would obviously be the competitive intensity in this segment is quite large with all players, whether it is banks, the larger HFCs, the smaller ones, the new ones, everyone trying to expand their business. And in order to sort of shore up their profitability, we are seeing entities across the spectrum try and build up their non-housing portfolio, as it gives them a better risk-adjusted return. The affordable housing or the smaller HFCs obviously look at the loan against property segment, whereas the larger HFCs, given their stronger balance sheet and their larger net worth, are able to cater to builder financing to provide an overall yield pickup and slightly improve their operating metrics by using this strategy.
My question to you is, what is the underlying risk that you're trying to sort of detail? Are you suggesting that this will lead to higher recognition of NPAs? Is that what you're alluding to?
Now, what we're seeing is, from historical studies, the conventional home loan, the losses have been very, very low. But compared to the non-housing portfolio, whether it is builder financing or loan against properties, the risk is definitely higher as compared to the conventional housing loans. So over the last couple of years, with the mix of non-housing loans are increasing, we are just saying that there's something to be watched out for. At this point in time, the risks are still manageable. One is not really losing sleep over this, but we're just trying to reiterate the fact that in quest of shoring up profitability, there is a small bias towards realigning the portfolio mix. So that's something which one has to be cognizant of, and one needs to watch out for how this pans out over the next couple of years.
Kartik, so these loan against property segments, and I know you said that they make up about 25% of the non-housing loan books of smaller HFCs, if I have that number correct. Can you give us any sense of what the asset quality experience in this LAP product has been? Nobody really has a clear sense.
No, LAP product, the nomenclature is quite varied across various players. You have some entities calling it as an SME loan, some entities call it LAP. But if I was to sort of just look at it on a combined basis, NBFCs are also quite active on the SME stroke LAP kind of a financing, so are HFCs. The primary customer profile for all these are the self-employed kind of a segment. So if we were to broadly look at this particular segment, the 90-day delinquencies, which let's say a couple of years back was about 1.5% or thereabouts, has definitely increased close to 2.5 or 3%. For some places, even exceeded 3%. Whereas on the home loan portfolio, at a system level, the 90 DPD or the gross NPAs at an average are still at about 80 basis points. Our own assessment over the near to medium term, it should still remain within 1.3%. So to that extent, there is definitely a divergence in the credit profile or the risk appetite of these two product segments. And as the proportion of non-housing increases, one has to basically look out for risk in case it emerges as far as select players are concerned. At an overall industry level, what we've been seeing is while delinquency numbers have been increasing, the property values have not really fallen. We've not had too much instances where one has had to repossess, sell, and maybe at an overall loss levels, the numbers are still under control.
Okay. Kartik, just
should this trend increase and yep.
No, sorry, I didn't mean to interrupt you. I was just going to put in one last question before we run out of time on the conversation. You pointed out the geographical spread. I'm wondering what point you were making in that. Are you saying that some of these markets are getting more concentrated and hence lending standards in HFCs which are concentrated here may be under pressure? Why did you make the point that this lending is very concentrated?
No, what we've just said is this is the fact. I mean, from the various portfolio cuts that we've got, we've seen that almost 60% of the loan book for the 24 odd players that we've analyzed, a large part of the business comes from the 4 states: Maharashtra, Delhi, NCR, TN, and Karnataka. Similarly, if we were to look at it for the smaller players, a similar amount of 60% comes from the west of India. So it's just a point that we're just trying to highlight, that across players, a large part of the business seems to be, relatively speaking, in these 4-5 kind of states. While the government thrust on housing for all by 2022 and the recent pace of new buildings, new homes to be constructed pan-India, especially on the affordable segment, one could see this trend change over the next couple of years, but as we speak, this is what the data point suggests.